By 2026, two of the planet's most powerful financial institutions are staring at the exact same global economy and seeing two totally different futures. One is sounding the alarm, warning us about a sluggish, fragile, and unequal recovery. The other, it's betting on a major comeback, powered by tech and trillions of dollars in stimulus. On one side, you have the World Bank. On the other, you have the big financial players, whose outlook is shaped by the policies of the US Federal Reserve. The trillion-dollar question is, who's right? More importantly, how do you protect your money and your family's future when the experts can't even agree on what's coming next? We're going to break that down today, because the truth about the 2026 economy is probably hiding somewhere in the middle, and finding it is the key to getting ready for whatever comes our way. Let's set the stage. In this corner, we have the World Bank. Its job is to look at the entire planet, especially the most vulnerable economies. When it puts out a forecast, it's not just about stock prices, it's about poverty, human development, and whether dozens of nations can keep the lights on. And lately their outlook is unsettling. After a period of chaos, they've projected global growth to weaken to just 2.3% in 2025, with only a tepid recovery expected in the 2026-27 period. Tepid is not a word you want to hear from an institution focused on global stability. Their forecast is loaded with warnings about escalating trade wars, persistent global uncertainty, and the crushing weight of debt on low-income countries. The World Bank basically sees a world struggling to stand up, with the poorest nations getting left further and further behind. Now, on the other side of this economic tug-of-war, there's a much more optimistic crowd. This group includes major investment banks like Goldman Sachs and Morgan Stanley, with a more moderate view coming from the International Monetary Fund, or IMF. Their perspective is heavily influenced by the actions of the world's most powerful central bank, the US Federal Reserve. While the Fed doesn't issue its own long-range GDP forecast, its interest rate policy is the sun around which the financial world orbits. And the big banks, looking at the Fed's likely path, are painting a much brighter picture for 2026. Goldman Sachs, for instance, is calling for sturdy global growth of 2.8% in 2026, with the US economy accelerating to a surprisingly strong 2.6%. Morgan Stanley is even more bullish on the global economy, forecasting 3.2% growth. The IMF is also on the positive side, though more cautiously, projecting global growth at 3.1% for 2026. So there you have it. The World Bank sees a fragile world, struggling to grow. The financial giants see a sturdy, accelerating economy. One says storm clouds are gathering, the other sees blue skies ahead. To figure out who might be right, we need to understand why they're looking at the same world and coming to such different conclusions. The World Bank's pessimism is baked into its mission. It's primarily focused on the economic health of developing nations, and from that angle, the future looks pretty risky. First, they're worried about the long-term damage from global shocks. For these poorer nations, the recovery has been slow and painful. They don't have the money to launch massive stimulus programs. In fact, it's the opposite. They're drowning in debt. As global interest rates have gone up, the cost of paying that debt has become crippling. This pulls money away from essentials like healthcare, education, and infrastructure, trapping them in a cycle of low growth. Second, the World Bank is laser-focused on the dangers of geopolitical instability and what they call trade fragmentation. They see the rise of protectionism and trade barriers not as abstract policies, but as direct threats to the supply chains that developing economies rely on. When the big economies build walls, smaller export-dependent countries are the first to get hit. The uncertainty alone is enough to freeze investment and put the brakes on development. Finally, the World Bank just doesn't see a powerful engine for growth in these economies. While the developed world is buzzing about an AI-driven productivity boom, many poorer nations are still trying to solve basic infrastructure problems. Without huge investments and a stable global scene, the World Bank's forecast for a tepid recovery starts to sound less like pessimism and more like realism. So, why are the big financial players so much more upbeat? It's all about focus. They are mostly looking at the world's largest economies, particularly the United States, where they see some powerful forces pushing for growth. The biggest driver here is the expected path of the Federal Reserve. After a historic battle against inflation, the consensus is that the Fed will continue to cut interest rates in 2026. Some forecasts see the Fed's key policy rate dropping to a range of 3% to 3.25%. Lower interest rates are like a massive shot of adrenaline for the economy. It gets cheaper for businesses to borrow and expand. It gets cheaper for you to get a mortgage or a car loan. This loosening of financial conditions is a huge tailwind for economic growth. The second pillar of their optimism is a tech-driven productivity boom, especially around artificial intelligence. Major banks believe we're just at the beginning of a huge investment cycle in AI infrastructure. Everything from data centers to semiconductors. This spending directly juices GDP, and the optimists think the productivity gains from AI will start spreading through the whole economy, allowing for faster growth without sparking runaway inflation. The third driver is good old-fashioned government spending and tax policy. Several forecasts from firms like Goldman Sachs specifically mention the potential impact of tax cuts, which could put more money directly into consumers' pockets and boost spending. This, combined with ongoing government investment, adds another layer of fuel to the economic fire. Put these three things together: cheaper money from the Fed, a tech-fueled investment boom, and supportive government policy, and you've got a recipe for a strong U.S. economy. And because the U.S. is such a massive engine for global demand, that optimism spills over into the global forecasts from institutions like Goldman Sachs, Morgan Stanley, and the IMF. We're about to get into the most important part: what this clash of visions means for you and your wallet. But first, if you're finding this breakdown useful for making sense of the economy, do me a favor and hit that subscribe button. My goal is to decode this stuff every single week to help you stay ahead of the curve. So we have two competing stories. The World Bank is warning of a fragile, unequal world, while the markets are betting on a boom fueled by tech and stimulus. The most likely outcome is that they'll both be a little bit right. We'll probably see a two-track world: stronger growth in the US and other advanced economies, with ongoing struggles in many developing nations. This uncertainty is exactly why your financial plan needs to be bulletproof. You can't bet on just one outcome. Here's a three-part playbook for navigating 2026, designed to build resilience no matter who wins this debate. Part 1. The All-Weather Foundation. This is the stuff you have to do, period. Boom or bust, this is the bedrock of your financial life. First, your emergency fund. This is non-negotiable. In a shaky world, cash gives you power. Having 3 to 6 months of essential living expenses parked in a high-yield savings account is your shield against a job loss or any other surprise that life throws at you. Second, crush high-interest debt. Credit card balances, personal loans, anything with a variable rate is a direct threat to your financial health. Paying down this debt is a guaranteed return on your money and frees up cash flow, which is critical in any economy. Third, check your diversification. Now is the time to make sure your investment portfolio isn't a one-trick pony. A well-diversified portfolio should have exposure to different things, like stocks and bonds, and different places, like various geographic regions. This is what keeps you from getting wiped out if one part of the economy stumbles. Part 2. The World Bank is right strategy. Let's imagine the World Bank's more cautious scenario happens, and we hit a patch of sluggish global growth. In that world, defense is the best offense. You'd want to make sure your portfolio has a healthy dose of defensive sectors. These are companies that sell things people need no matter what. Think consumer staples, food, toilet paper, healthcare, and utilities. This is also a world where value stocks often shine. These are solid, profitable companies that might be trading for less than they're really worth. When growth is scarce, investors tend to favor stability over speculation. Finally, in a riskier world, holding a bit more cash and high-quality bonds gives you both a safety net and the dry powder to buy great assets if they go on sale. Part 3. The Fed and Cobra are right. Strategy. Now let's flip the script and say the optimists are right. Easier money from the Fed and the AI boom kick off a period of strong growth. In this world, you want to be ready to play offense. This means having exposure to growth sectors, especially tech and companies that are clear winners in the AI revolution. Think about the whole AI ecosystem, from the companies making the chips to those developing the software, and even the ones using AI to disrupt old industries. A strong economy also lifts cyclical stocks. These are companies in areas like consumer discretionary, restaurants, travel, industrials, and financials, which do really well when the economy is booming and people are spending money. The key is that you don't have to choose just one strategy. A truly resilient portfolio blends elements of both. You have your core defensive holdings to protect your downside, and your growth-oriented investments that let you ride the wave if the boom happens. So, who's right about 2026? The cautious World Bank or the optimistic crowd following the Fed? The real answer is complicated. The World Bank is correctly flagging the real dangers of debt, trade friction, and inequality that threaten global stability. At the same time, the optimists are right that rate cuts, government stimulus, and a game-changing technology like AI are powerful growth engines for advanced economies. The future isn't one clean storyline. It's a messy, complicated, and often contradictory tale that's still being written. But by understanding these different forces, you're no longer just a passenger on this ride. You're an informed observer. You get the arguments, you see the risks, and you know where the opportunities might be. You're now equipped to build a financial plan that doesn't depend on a perfect forecast, but is strong enough to handle whatever 2026 throws at us. If this video helped you get the bigger picture, give it a like to let the algorithm know. More importantly, drop a comment below. What's your take on this? Are you leaning toward the World Bank's caution or the market's optimism? And what's the number one thing you're doing to get ready? Finally, be sure to subscribe and hit that notification bell. The economy never stands still, and neither do we. I'll see you in the next video.